Imagine this, you just closed on your dream home and the payment comes in for almost $2,000 a month less than you're expecting. No, you didn't win the lottery, you used an interest-only loan. Sounding pretty good, isn't it? Well, here's the catch. So 10 years down the road, your payment jumps way the heck up. We're talking thousands of dollars again, and you're wondering yourself, did I make the right move here or did I just kick the financial can down the road? Interest-only loans can be a strategic power move. Used correctly, they offer cash flow, flexibility, and short-term savings. But if you don't fully understand them, they can wreck your finances faster than going to a Coldplay concert with a coworker. And I don't know how long this video is going to take it to get out, but hopefully that's still relevant when it comes out. Today, we're breaking it all down. What interest-only loans really are and what they're not, when and why they're used, especially in jumbo and investment scenarios, and real pros and cons so you can decide if it's a tool or a trap. Let's get into it. All right, let's demystify this. An interest-only loan is a type of mortgage where you only pay interest for a certain period of time, usually for the first 10 years. But here's what a lot of people don't realize. It doesn't have to be an adjustable rate mortgage. It can still be a 30-year fixed rate mortgage. You do have the option to take an ARM, but right now we're just talking about the amortization, not the adjustability of the rate, if that makes sense. For those first 10 years, you're not going to see your loan balance come down at all. You're just paying the interest, and that means lower monthly payments, sometimes dramatically lower. No equity buildup during that time, unless it's coming from appreciation of your property. And a serious payment bump once your interest-only period is over, usually going into a 20-year amortization at that point. So where do these types of loans show up? So these really aren't for your average first-time buyer. We'll usually see them in two scenarios. Number one is in the jumbo loan or luxury market, and that's usually over 806,500 currently. These buyers with high income and complex financial situations like the flexibility. Number two, investment properties. Investors love the additional cash flow, especially if they're flipping the property or just holding it shorter term. Why should you care? Interest-only loans aren't bad, they're just misunderstood. When you use them right, they're a tool, but if you're using them wrong, it can be a complete trap. The good news is they really won't even give you one of these unless you're super well qualified. All right, let's get into some of the pros and cons of this as promised. For pros, the biggest one is probably a lower monthly payment. So let's give an example of a $1 million loan at approximately 6% interest rate. A traditional 30-year fixed loan would give you a payment of around $59.96 per month. An interest-only payment would be $5,000 a month for the first 10 years. That's obviously a savings of $996 a month. Short-term strategy win. Might even make more sense to call this a medium-term strategy, because if you plan to sell or refinance in that first 10 years, this lets you keep your costs down during the hold. Better cash flow for investors. That extra $1,000 a month we talked about, that could go towards renovations, another deal, or maybe even your favorite ETF. Tax deductions on investment properties. Interest is deductible, which can help offset your income. Talk to your CPA for the specifics on that. Financial flexibility for high income earners. If your income comes in bonuses, commissions, or RSUs, this keeps more cash available when you need it. The cons, let's be real. The payment shock can be brutal. After 10 years, that same $1 million loan has only 20 years left. Your payment jumps from the $5,000 we talked about to roughly $71.65, because now you're paying principal and interest, and it's over a shorter period of time. No equity growth. You're not building ownership unless the property appreciates. If prices drop, and that kind of leads into our next point, you're vulnerable in a down market. If values fall and you've made zero progress on paying down your principal, you could owe more than your home's worth. And our last con is stricter loan guidelines. Most lenders want a 720 credit score. They're going to want to see your reserves, so about 9 to 12 months of the PITI payments, and they want lower ratios, debt to income ratios as well. So these are much harder to qualify for. All right, let's talk about when it makes sense and when it doesn't. Just for the record, this is not a live, laugh, love sign right here. Just wanted to come out and say that. It's a smart move if you're flipping or selling less than 10 years. If you're a high income earner with heavily bonus or performance based, and if you got a plan for paying down, refinancing, or exiting. And it's probably not for you if you're buying at the top of your budget. You need stability and predictable payments for the long term, or if you're assuming appreciation is going to bail you out. So should you use an interest-only loan? It really depends. If you're an investor, high net worth individual, or just somebody with a strategic plan, it can be a great tool. But if you're relying on home price appreciation and you're barely qualifying for the home to begin with, when it goes to that fully amortized 20-year loan payment, it can really put you in a bad situation. So final takeaways, it's not the rate that's special, it's the structure. Plan ahead for year 11, know what's coming. You do have plenty of time to plan, so that's definitely helpful. Don't use it to buy more house, use it to buy time or more flexibility. Now, if this video is helpful at all, I ask you to please smash the like button. It helps other folks find the video. And subscribe if you want more super niche mortgage tips like this. And let me know in the comments, would you ever use an interest-only loan and why or why not? Thanks for watching, and I'll see you in the next one.